Hi, I'm Riley Kemmer. I'm a licensed loan officer, and today I'm answering mortgage questions from the internet. From Frank L on Instagram, he asks, I've heard that changing jobs right before closing can mess up your loan, but what if it's the same industry and even a higher paying position? Would that still be a problem? Switching jobs in the same industry to a position that's going to have a higher pay structure is usually going to be fine in most scenarios. A few things that could cause problems is if at your old position you were a W-2 employee and this new role you're taking you would become a 1099 employee, that would change your pay structure because you would now be considered a self-employed borrower. Any sort of job gap could also cause an issue. And lastly, if you are relying on any overtime or bonuses from that previous position, your loan officer is going to have to recertify that you are going to continue receiving those additional forms of income at your new position. In short, if you can avoid changing your role before closing on your loan, I would suggest that you do. That's usually the easiest way to avoid any problems. But if it's an opportunity that you can't pass up, talk with your loan officer first, make sure that they know the whole picture and everything that's going on so that they can keep you on track to close when you're expecting to. From YouTube, CMA11K asks, I keep seeing DTI everywhere. How bad is it really if mine is a little high? Like, will lenders straight up deny me? So for those of you that aren't familiar with DTI, it is your debt to income ratio. This is a ratio that's calculated by taking all of your monthly obligations, anything from car payments, credit cards, student loans, and other mortgages divided by your monthly income, and that gives us a ratio. Most loan programs are going to have a DTI cap somewhere between 45 and 55%. So if you are above that, then it could potentially cause problems and result in you getting a loan denial. I've worked with a lot of people who going into the process, they're scared that their DTI is going to be too high. What I would suggest is if you're worried that that could be an issue for you, reach out to me or your local lender that you trust and have them put together a plan where they're calculating that DTI and getting you on the right path to reduce that so you can qualify in the near future. From YouTube, Norb Hammer asks, is there ever a situation where paying off a debt before applying for a mortgage actually hurts your chances of getting approved? A significant portion of your credit score is calculated by your total credit utilization and your average length of history on your lines of credit. Sometimes when you do pay off a balance entirely, the creditor will actually close that account. And when that happens, your credit utilization can sometimes go up because now you just eliminated, potential lines of credit that you had. And in other cases, your average length of credit can also go down, both of which could lower your credit score. I'm not a credit expert, but what I've witnessed in the past is when something like this happens, the score usually bounces back in the next month or two. But if you've already started the loan process, it's usually smarter to talk to your loan officer first and let them know what you're planning on paying off. Most of the time, they're going to have some sort of simulator that they can tell you what's going to happen and if it's going to affect your chances of closing on your home. From Instagram, Jason C asks, what's one thing that seems small but can totally derail a mortgage approval at the last minute? I know I've talked about this once before, but this is a point I like to hammer home because you'd be amazed the amount of times I see this. I don't know if lenders just aren't doing a good job educating their clients in it or what's going on. But a lot of people, they end up transferring money around from their different bank accounts right before closing. This is something that we have to source. So any big changes in your bank accounts, any movements from your savings to your checking, all of that's going to have to be sourced and looked at by an underwriter. So anything like that can actually potentially delay your closing. I know that's something that usually isn't on the top of people's mind because it's your money anyway. So why should it matter? But it does. So make sure if you are going to move anything around, keep everyone informed on what you're doing. They might need a few more updated bank statements. BKim54 on YouTube asks, and this is a long one, should I reach out to a loan officer before or after looking for a home / finding a potential price range that I might be looking at? What is the standard process timeline and what are the benefits or drawbacks to reaching out at different times? I'm going to answer this in kind of 3 different parts. So firstly, I do always recommend reaching out to a loan officer before you go out shopping for a home. There's a lot of reasons to do so, but I think most importantly is there's no point in wasting your time looking at homes that maybe are way under your qualification limit or way above it. It's just going to be a waste of your time. It's a lot better to kind of know the area that you should be searching in, that price range, so that you are actually looking at houses that you could potentially buy in the near future. As far as the standard timeline and process, this kind of varies from person to person. I've worked with individuals that really only need a day to get qualified, and then they're under contract the next day. I've also worked with individuals who take 6 to 12 months to get things ready and get to a comfortable position where they're ready to purchase a house. So that's going to vary on an individual basis. The timeline itself, that again is going to change, but most of the time, once you're under contract on a house, it's usually going to close in 30 days or less. As far as different benefits and drawbacks to reaching out at different times, I don't think there really is a drawback. There's really no obligation when you have that first conversation with a lender. So if you talk to someone, if you give me a call, I'm not going to be calling you every day saying, hey, are you ready to buy this house? It's really just going to be working on a process to get you ready so you can make a move whenever you feel comfortable. VKim54 on YouTube also asks, as someone who is not yet seriously house shopping, but planning to be in the market in the near future, what is the most important, impactful things I could be doing to set myself up for success down the road? For example, should I just focus on saving as much money as possible? What I would recommend is reaching out to someone like me or your local lender that you trust, someone that's going to be able to put together a unique, individualized plan for your home buying process so that you know exactly what you need to focus on so that in the near future, when you do decide to buy, you've been working on the right things. All right, last one from BKim54 from YouTube. He asks, as someone who's not well versed in the process of buying a home, what would you suggest is a good amount to save for a down payment? What do most people have available? I know most people, when they think about down payments on a mortgage, they usually hear that 20% number being thrown around, but in all honesty, that's not very attainable for a lot of people, especially first-time home buyers. There's a million different loan products and programs out there that help with down payments. Some are 3% down, some are 3.5% down. There are even ones that help you close with no down payment. So as far as what do most people have available, it's really going to be unique to them. And what I suggest is never spending more than what you're comfortable with. You obviously don't want to be moving into a house with nothing saved for any emergency funds or anything else that could happen in your life. So work with your loan officer, find out what your financial situation is and what program is going to serve you best. And that's usually the direction that's going to be better for you. Thanks again for checking out this episode of Mortgage Support. As always, if you have your own questions, feel free to comment them below and we'll make sure to answer them in the next episode.